Here at First Asset, our drive to be your most trusted and leading-edge ETF provider means that not only are we constantly trying to develop innovative and practical new investment solutions for you, but we're also trying to keep you abreast of new investment opportunities before they materialize. Over the next 5 or 6 minutes, we'd like to present the near-term opportunity in high-yield bonds and how you can capitalize on it. Before we begin, though, we ask that you please take a quick moment to familiarize yourself with the following disclaimer, and be aware that this presentation is intended for informational purposes only, and is not and should not be construed as investment advice to any individual. Individuals should seek the advice of professionals as appropriate regarding any particular investment, and read the prospectus before investing. When we look back at high yield in 2015, there was really a tale of two markets. We saw in the first half of the year, yields were modestly declining, but then changed course and climbed rather significantly from June through December. Of course, as a result of the inverse relationship between bond yields and bond prices, we saw the performance of this asset class do just the opposite. And what the blue line here is showing you is that the high yield investor would have been up about 3% through the end of May, but over the subsequent 7 months, they would have seen their assets decline by 8%, leaving them down roughly 5% for the year. And this challenging second half of the year was really driven by some macroeconomic concerns. We saw slowing Chinese GDP growth and pretty steep declines in the price of oil that had investors concerned that there might be a recession coming, and that the weakness in the energy sector might end up spilling over into other sectors of the high-yield market. Now, while a negative 5% return in 2015 might not sound all that bad, it actually marked one of the worst years on record for high yield. You'll see here that while 2008 was absolutely far worse, 2015 and 2000 were essentially tied as the second worst years. Now, before we move on from this slide, here are a couple of things to keep in mind as you consider a potential allocation to high yield bonds. Number one, 23 of the last 29 years have been positive for this asset class. That works out to 4 out of every 5 calendar years, or 80% of the time. And number two, if you look all the way back to 1987, which is the inception date of the Bank of America Merrill Lynch High Yield Bond Index, high-yield investors have never lost more than 5.1% in a given calendar year, except for the 2008 financial crisis. And I think many people would agree that that was an extreme outlier event. Now, that's a pretty good track record for an asset class that's sometimes referred to as junk bonds. If we get a bit more granular now and look at the rolling one-year performance, we can see that the longer-term average has been roughly 9%. Also, similar to our last calendar year slide, the rolling one-year returns have been positive 82% of the time. And for those of you familiar with statistics or probability theory, the blue shaded area represents a plus and minus 1 standard deviation band around the average return of 8.9%. And what that means is that we confidently expect that the rolling one-year returns should fall within this blue shaded band roughly 70% of the time. Yet we've recently breached that lower floor. And when we've seen this in the past, the performance has turned around relatively quickly and broken through the upper bound. This next slide depicts historical credit spreads, and for those of you that are less familiar with fixed income, a credit spread really just measures the differential in yields between, in this case, high-yield bonds and comparable U.S. Treasury bonds with similar maturity profiles. Yield spreads are generally interpreted as the compensation that an investor will receive for taking on any incremental risk compared to the relative safety of being in a U.S. government bond. And what we're seeing now is that credit spreads are at 705 basis points, or 7.05%, which is 180 basis points above their long-term average. Since 1997, when month-end spreads were 700 basis points or greater, the average cumulative returns over the subsequent 1 and 2 years were 16 and 33% respectively. We can also see with the blue shaded areas here that periods where spreads compressed meaningfully resulted in annualized double-digit returns. Some of you may be hesitant to allocate to high-yield bonds because of some of the default concerns out there. And while we did see default rates climb from 2% in 2014 to 3.5% in 2015, half of those defaults in total dollar terms came from the energy sector. And that really underscores one of the most important reasons why you should consider an actively managed solution for high yield, rather than a simple passive index tracking strategy. The reason for that is because whether it be in high yield or equities, market cap weighted strategies are going to position you in bonds or stocks of large companies, not necessarily healthy companies. So if this high yield opportunity seems to resonate with you, but you're not so sure about the energy exposure that you're going to get in an index tracking product, we may have an ideal solution for you. First Asset Active Credit ETF, going by the ticker FAO on the TSX, is an actively managed ETF that's overseen by Onyx Credit Partners, a highly respected and experienced team of fixed income specialists that currently manage over $6.5 billion US dollars. The fund is managed pretty conservatively, focusing on capital preservation, using in-depth credit research to select some of the best risk-adjusted return opportunities, both in the high-yield bond space as well as the senior secured loan space. And this ability to tactically allocate between these two asset classes really allows the fund to manage risks through all kinds of interest rate and credit environments. And of course, one of the main reasons you may be considering an allocation to high-yield bonds is to get the high yield. And this ETF certainly provides that with a current distribution yield of roughly 5% that's paid monthly. Finally, the recent results highlight the favorable risk-return profile of the fund. You'll see in 2015, the fund meaningfully outperformed the Credit Suisse High Yield Index, mitigating drawdown in what would turn out to be a very challenging environment, while providing nearly full participation during the recent rebound in both the month of March 2016 as well as over the first 3 months of 2016. Thank you very much for your time and consideration. If you're an investment advisor, we encourage you to reach out to one of our dedicated sales representatives to learn more about this compelling opportunity. If you're an individual investor, we ask that you please speak with your investment advisor to learn more about high-yield investments as well as how this ETF might fit within your portfolio. Thanks again, and we look forward to speaking with you further.